is up 7.5%. Good move on that one. Shifting focus then, time to get into a very important fundamental conversation in terms of what to make of the updates and earnings we've seen so far. Where is the action in the market and where should you be betting right now? We've got Mr. Dixit Mittal, the Senior Fund Manager of Equity at LIC Mutual Fund, joining us on the show. Dixit, hi, good afternoon. Good to be speaking with you. Let's start by getting your sense on how you're seeing the markets. We've seen a resurgence of all the geopolitical tensions once again, but so far the markets have been largely resilient. We've been in a band of about 200 points here and there, but nothing major like we had seen in the first leg of the war. How are you reading the way the market has this time reacted to this escalation, and do you believe that the concerns are largely priced in now?
Yeah, good afternoon. Thank you for having me on your show. So basically, as you rightly mentioned, market has been trying to remain resilient because we have seen time and again that both the parties they want to end this war. So there may be some flare-ups and then settlement coming in. But more or less, the things are moving in the right direction in terms of settlement and maybe the reopening of Hormuz. I think, and one more thing which is supporting the market is the valuations, because for the last 2 years, markets has been more or less flat. And currently, based on the consensus estimates, we are trading below long-term averages in terms of valuation. So I think that is the support that markets are having. But only trigger that markets are looking for is the basically earning revival, because earnings for the last, I think, 5, 6 quarters have been growing in the single digit. And based on the current estimates, I think market is hoping for some acceleration in the earnings from FY27 onwards. And the sooner this conflict ends, I think the market will get confidence that earning revival is on the cards, and then market can find their way upwards. But as of now, because things are moving too fast, and also the market will also try to look at the Q1 earnings, how they pan out. Are there any earning downgrades further? I think those things will determine. But on the fundamental basis, on the valuation front, I think we are okay. And only thing we need to watch out for the earning trajectory from here on.
What's the preference, Dixit? Is it, hi, this is Harsha, by the way. Is it large cap versus mid small? What's the preference or the tilt?
Yeah, so basically, rather than going by the standard definitions of large or mid or small cap, we internally try to see what are the sectors which are adding incremental growth to the corporate earnings or maybe to the GDP. And as of now, what we believe is the sectors like financials, like you see the whatever 3 quarter updates have come in, I think the loan growth have been quite healthy in mid to high teens. So financials, I think, should do well. Second is domestic pharma, the kind of monthly numbers that we are seeing on the IPM. I think those are seeing some kind of acceleration. Most of the companies are going in low double digit to mid teens. I think domestic pharma is the sector to look out for. And then maybe some of the new age companies who are taking market share away from the brick and mortar companies. I think those companies should do well. They continue to do well. I think in future also they can do well. And then one more thing, what we are noticing is export story, domestic manufacturing as well as export story. I think that is panning out quite well. In fact, the last month's trade data that we saw, I think the manufacturing exports have grown by double digit if we remove the oil part. So I think that is the theme. And within that, engineering goods, chemicals, pharmaceuticals, I think those are the few sectors I think which are seeing strong traction. And these are the sectors we are betting on. And whatever companies who are participating in this growth, I think we are investing into that.
Some of the sectors that you're liking. Dixit, unfortunately, we have to slip into a time-bound commercial. Stay on with us. We'll continue this conversation on the other side of this very short break. Before we do that, viewers, up next is a quick interaction with Sumit Industries on its from the Suzlon studio here at ET Now. Before the break, we were in conversation with Dixit Mittal, the Senior Fund Manager at LIC Mutual Fund. And let's keep that conversation going. Before the break, Dixit, first of all, thank you so much for staying on. Dixit, before the break, you told us about some sectors that you're liking, financials, pharma. What about the ones that you are not comfortable looking at right now, since this approach is largely top-down? Give us a sense of where you believe the earnings growth is either lagging or the valuations don't look very attractive right now.
As of now, we are avoiding global commodities because there's too much volatility globally, and it's very, very difficult call to take where this will end and where the prices of commodities will settle. So as of now, except from global commodities and to some extent IT, where we don't have the visibility as of now when the growth will pick up, I think these are the two sectors we are underweight. And in terms of overweight, as I mentioned, consumer, healthcare, financials, and manufacturing export theme, I think we are betting where we have good growth visibility and where we believe that investors can make good compounding returns over a 3 to 5 year time period.
And trying to get a sense, Dikshit. So IT, currently you're sitting out of it just because of no growth, but valuations coming off sharply. Isn't there value emerging over there? I mean, at some point, growth is likely to kick through. Is that your thesis?
Yeah, right. You're right. Valuation wise, I think most of the large cap companies are trading below 15 times P multiple. So one can say that they are trading close to the bond valuations, and market is not ascribing any major terminal growth to these stocks. So no doubt these companies may fall into the value zone. But for us, I think we'll tend to buy these companies when we have slightly better visibility on the growth picking up because equity as an investment, I think investors look for growth and where we have good visibility on the earnings growth with a large degree of confidence, then only we can invest there. So as of now, I agree that on a valuation front, these stocks are cheap. So that's why we are not avoiding completely. We are underweight on this sector. But to increase to weight to neutral or overweight, I think we'll look out for the more evidence before turning more constructive on the earnings growth revival for these companies.
So it's largely a wait and watch approach that you are adopting when it comes to IT. Dikshit, talk to us about your view on real estate. It's a sector that is just coming out of a slump. Post-COVID, it saw a spike, then saw a slump, and it's trying to come out of that now. We've seen some exaggerated moves on that index. How are you looking at that sector, and do you have any holding over there?
Yeah, we have some selective holdings in the real estate because, anyways, in the high inflationary scenario which we are seeing globally, I think hard assets tend to do well. I think this sector falls into that category. And more importantly, we are looking out for some of the companies which have built large annuity income in their portfolio. So even if there is some downturn in the residential part of the portfolio, they have good cash flows, visibility of the cash flows from the annuity portfolio. So particularly, we are liking the companies who have some kind of rental assets, whether it's commercial or whether it's like hospitality and all, performing some part of their value. And then on the real estate, we are positive. What we believe is that the kind of you can say pre-sales these companies are reporting, the kind of launch pipeline most of these companies have, and the you can say the incremental demand coming from employees of GCCs and all. I think those should continue to benefit this sector, but as a you can say as a safety net, we need to have some kind of annuity cash flows within the companies to be more constructive, so that these companies can withstand the downturn slightly more better.
How are you playing consumption, Dikshit, if you can give us a sense?
Yeah. Yeah, consumption, we are positive. Even if you see, even Q4 also, we saw some evidence of volume growth picking up. Even in Q1, whatever the pre-quarter updates we have seen from the companies, I think most of the updates have been quite positive. And after this GST rationalization, I think there is some amount of buoyancy in terms of the demand growth. More importantly, now inflation is also picking up. So I think on the nominal basis, these on the top line front, I think growth will accelerate on the consumer sector. So overall, we are positive, but we tend to remain invested into the you can say within these sub segments which have low penetration in India, rather than betting on the consumer staples. Some of the categories which are having low penetration as compared to our global peers, where the runway of growth is higher, so that one can be slightly more you can say confident in paying higher P multiple, because most of these consumer companies are trading at high P multiples relative to general market as well as the global peers. So wherever which categories where we are seeing a large runway from growth, where we are ready to pay premium also. So some of the categories like retail, footwear, or maybe some of the new age consumption companies, I think in these kind of pockets, I think we are investing to. Even packaged food, I think these some of the categories I think we are looking to invest.
Dikshit, you're very bullish when it comes to consumption. Good to hear that. Also give us a sense of in what, if you can quantify the kind of growth that you're expecting to see this earnings season or maybe a couple of quarters ahead. Why I'm asking is because, one side the geopolitical uncertainty is back in action. That escalation is something that we're seeing. But if you look past that noise, do you believe fundamentally or structurally India is well poised to deliver double-digit earnings growth?
Yeah, I think we seem to be poised for some kind of revival because the largest segment of the market, which is the banking sector, I think is showing some kind of acceleration in the loan growth as well as the NIMs are also seems to be bottoming out. So we are constructing at the start of this financial year. I think consensus, most of the brokers are expecting anywhere between 15 to 17% kind of earnings. But we need to see Q1 because Q1 can throw some kind of negative surprises also because this was a peak of this crisis and many of the companies, especially on the auto or maybe industrials, will see some kind of margin pressure because of this commodity inflation. So I don't rule out some of the cuts into the earning, but otherwise, I think as compared to the trajectory of last 2 years, where we have grown at 6-7%, I think there should be good amount of recovery. But only caveat is that this issue should not linger on much more. I think because Q1 earnings, I think market is now factored in. But if this issue lingers on and there is some impact on the Q2 earnings also, and then I think there may be some kind of downgrades in FY27. So internally, basically, we are trying to look out for the normalized level of earnings because one cannot predict when these things will settle down. So in a normalized scenario, we try to figure out what is the earning potential of a particular company or as a market as a whole, and then only we can take a call with a 2 to 3 years perspective whether we can invest or not.
So this one is going to be a long game to play out and watch for. But on that note, Dikshit, thank you so much for your time and thanks so much for sharing your views and how you're positioned right now. Thanks so much for sharing that with our viewers.
Thank you.
Thank you so much. Okay, viewers, then shifting focus.